Ladies and gentlemen, listen to me very carefully, because what happened last night was not normal and it was not an accident. If you woke up this morning, opened your trading app, and felt your stomach drop, you're not crazy. You didn't imagine it. You didn't overreact. What you saw was real, and it was brutal. Silver didn't correct. It didn't pull back. It didn't cool off. It was executed. 14% erased in a matter of hours. Billions of dollars wiped off the screen while most of the world was asleep. And the worst part? Almost nobody is telling you the truth about why it happened. One day ago, silver was being celebrated as unstoppable. Analysts were tripping over themselves to raise targets. Commentators were calling it the breakout of the decade. Then suddenly, in the dead of night, the price collapsed like a body falling through a trapdoor. No warning, no news, no explanation. Just pure, violent downside that felt completely disconnected from reality. People panicked, stops were triggered, accounts were damaged, confidence was shattered. And right on cue, the media showed up with the same tired explanation. Volatility, profit-taking, and retail panic. That explanation is a lie. What you witnessed was not a market correction. It was not a change in fundamentals. It was not retail traders deciding silver was suddenly worthless at 2 o'clock in the morning. What you witnessed was a mechanical execution carried out during the thinnest liquidity window of the entire year. It was a financial hit job performed in the dark when the market was defenseless. And if you sold into that collapse, you didn't just lose money, you were hunted. To understand what really happened, you have to stop looking at headlines and start looking at the clock. The crash did not happen during the New York Open. It did not happen during the London session. It happened around 2 in the morning Eastern Time, during the holiday Ghost Week, when liquidity is a joke and the order book is hollow. At that hour, the silver market is a ghost town. The retail investor is asleep. The pension fund manager is on vacation. The desks are empty. There's nobody home. And that is exactly why it happened then. At approximately 2 a.m., a massive leveraged institutional position hit its breaking point. We are talking about a hedge fund, a prime brokerage client, or a highly levered macro player who was riding the silver rally with borrowed money. When price moved against them, they didn't get a polite phone call asking for more margin. They breached maintenance margin. And in the institutional world, that means one thing: forced liquidation. No discretion, no negotiation, no mercy. The position was handed to a risk engine, a cold, emotionless algorithm with one instruction burned into its code: sell everything now. This machine does not care about fundamentals. It does not care about support levels. It does not care about RSI, Fibonacci, or your long-term thesis. Its only job is to dump contracts until the account is solvent again. And it does this using market orders, not limit orders. Now imagine unleashing that machine into a market with full liquidity. The damage would be contained. Price might dip. Buyers would step in. But this wasn't a normal market. This was Ghost Week. The bid stack was paper thin. When the first wave of sell orders hit, there were no buyers. So the algorithm dropped the price to find liquidity. It sold again, no buyers. Dropped the price again, 80, 78, 76. Each level failing instantly because there was nobody there to catch it. This is what professionals call a liquidity cascade. Once it starts, it feeds on itself. Price falls not because value is changing, but because the market is searching for buyers who do not exist. It is like throwing a grand piano out of a window. It doesn't stop because it wants to. It stops when it hits something solid. But the damage didn't end there. As price collapsed through key strikes, another machine woke up. The options dealers, the market makers, the gamma hedgers. And this is where the situation went from bad to catastrophic. As silver dropped, dealer gamma flipped negative. That means for every dollar price fell, the dealers were mathematically forced to sell more silver to hedge their exposure. This created a feedback loop of destruction. Price down, dealers sell. Dealers sell, price down further. A robotic doom loop that accelerates the crash far beyond what fundamentals justify. All of this happened while you were asleep. So when you look at that massive red candle, understand this clearly. It was not investors voting against silver. It was a plumbing failure. It was leverage snapping. It was machines cannibalizing a market that had temporarily run out of buyers. And when something like that happens, the system itself is put at risk. Because here is the part nobody on financial television is talking about. When a leveraged whale blows up that fast, the problem doesn't stop with them. For every long contract they held, there was a short contract on the other side. If the losing party cannot pay, the clearinghouse is on the hook. And if the clearinghouse is on the hook, the entire financial system starts to tremble. That is when the alarms went off. Right near the bottom, as silver was staring into the abyss, stress exploded in the overnight funding markets. Counterparty risk spiked. Banks became afraid to lend to each other. The plumbing began to seize up. And that is when the emergency lever was pulled, quietly, without a press conference, without a headline. A massive amount of liquidity was injected into the system. $34 billion. That number is not speculation. It is visible in the repo market. It is visible in swap lines. It is visible in the data if you know where to look. This was not stimulus. This was not easing. This was emergency surgery. The system was hemorrhaging, and the only way to stop the bleeding was to flood it with cash. And here is the critical insight. The Fed did not step in to save silver. They do not care about silver. They stepped in to save the system. They let the whale die, but they saved the ocean. That liquidity injection stabilized the bid stack. It gave market makers the confidence to step back in. It prevented a clearing failure. And that is why the crash stopped. Silver did not find a bottom because of hope or optimism. It found a bottom because the system hit its own pain threshold. The moment liquidity returned, the free fall ended. That level, the level where the bleeding stopped, is not random. It is the line where chaos meets control. That line is the most important reference point going forward. Because what happened next is even more telling. In the middle of this paper massacre, while New York was burning down, another market looked at the entire event and shrugged. The physical market, Asia, Shanghai. While Western traders were panic selling contracts, the real metal was trading in a completely different reality. No crash, no collapse, no panic, just steady pricing driven by actual demand. This disconnect is not normal. It is not sustainable. And it tells you something terrifying about how fragile the paper market really is. But before we go there, before we talk about East versus West, before we talk about physical premiums and vault withdrawals, you need to fully understand this first phase. The crash was engineered by leverage, amplified by algorithms, and stopped by emergency liquidity. It was not a verdict on silver. It was a stress test of the system, and the system barely passed. In the next part, we are going to follow the money after the crash. We are going to expose who actually bought while everyone else was panicking, why a specific price level became a concrete floor, and how the physical market is quietly calling the bluff of the paper market. This story is just getting started. If you thought the crash was violent, wait until you understand what happens next. Ladies and gentlemen, now that you understand how the crash happened, now that you understand it was not organic, not fundamental, and not driven by retail panic, we need to talk about the most important question of all. Why did it stop where it did? Why didn't silver continue collapsing into oblivion? Why didn't it go to 60? Why didn't it go to 50? If the order book was empty, if the selling was mechanical, and if negative gamma was forcing dealers to puke contracts into a vacuum, the math says the price should have kept falling until it hit zero. That is how liquidity cascades work. When there are no buyers, price finds zero. But that is not what happened. Silver hit an invisible wall and bounced violently. That wall was not hope. It was not retail traders waking up at 3 a.m. It was structure. And that structure now controls the next phase of this market. The level where the crash stopped was not random. It was not coincidence. It was a pre-selected zone where multiple forces were already waiting. Long before the crash even happened, long before the whale blew up, long before the risk engine started firing market orders, capital had already decided that this was an acceptable place to buy. That level is $75. And if you don't understand why 75 matters, you are blind to how markets actually work. Back in November, silver spent weeks fighting at that exact level. It was not quiet consolidation. It was war. Every rally attempt was rejected. Sellers defended 75 aggressively. Buyers chipped away patiently. Volume built up massively in that range. Contracts changed hands over and over again. That zone became embedded in the market's memory. It became a reference point. When silver finally broke above 75, it was not just another dollar higher. It was a regime shift. It was the moment the market moved from range to trend. And markets never forget those moments. When price later collapses, it does not fall into empty space. It falls back to where the battle was fought. That is where liquidity lives. That is where institutions place size. That is where algorithms expect reactions. 75 was not just support, it was a magnet. And when the liquidation wave slammed into it, the selling pressure ran into buyers who were not emotional, not reactive, and not afraid. This is where retail traders misunderstand price action. They see a 14% drop and assume weakness. Institutions see a return to a high volume node and see opportunity. They do not chase price at 83. They wait, they let leverage destroy itself, and when panic delivers price back to structure, they step in. Now we need to talk about the machines again, because humans were not the ones defending this level. The algorithms were already armed and waiting. Modern markets are run by code. Over 60% of all volume is executed automatically. These systems do not feel fear. They do not read headlines. They do not care about narratives. They care about probability, volatility, and predefined mathematical thresholds. When silver collapsed, it tagged a zone where multiple algorithmic triggers aligned at the same time. Fibonacci retracements, volatility compression bands, volume-weighted averages, and historical liquidity nodes all converged around the mid-70s. This is not mystical. This is engineering. When enough models point to the same area as statistically favorable, buying programs activate. And when those programs activate into panic selling, Price snaps back violently. Silver did not just bounce, it rejected lower prices. That distinction matters. Bounces fade, rejections hold. Look at the candle structure that formed. A long lower wick, a small body near the highs. That is not random noise. That is a hammer. And a hammer at a meaningless level is worthless. A hammer at a structurally critical level after forced liquidation is deadly for the bears. It tells you sellers threw everything they had at the market and failed. It tells you demand overwhelmed supply. It tells you that the lower prices were unacceptable. Volume confirms this. During the crash, sell volume exploded as forced liquidation dominated. But as price approached 75, that volume dried up. Sellers were exhausted. There was nobody left who needed to sell at that price. Then, as price stabilized, buy volume surged. That sequence is the fingerprint of accumulation. You cannot fake it. It means large players were absorbing contracts quietly while the public was still in shock. Momentum tells the same story. The RSI did not collapse into oversold territory. It held in a bullish range. In weak markets, momentum breaks. In strong markets, it resets shallowly and turns back up. Silver's momentum never died. It paused. That is the behavior of an accelerating trend, not a collapsing one. But here is where the story gets truly uncomfortable for anyone who believes the crash was real. While the paper market was imploding in New York, the physical market was doing something completely different. And this is the part that almost nobody wants to talk about, because it exposes the entire illusion. Let's talk about Shanghai. While silver futures were being liquidated in the West, the Shanghai Futures Exchange was calmly pricing silver as if nothing happened. No crash, no panic, no 14% collapse. The price in China held firm near levels that translate to nearly $90 an ounce. Let that sink in. At the same moment, silver was trading in the mid-70s in New York. The physical market in the East was valuing the same metal nearly 20% higher. That is not a small discrepancy. That is not noise. That is a broken market. In a functioning system, arbitrage would close that gap instantly. Traders would buy silver in New York at 75 and sell it in Shanghai at 89. The spread would collapse in minutes, but it didn't. The gap remained wide. Why? Because the metal cannot move freely anymore. Export restrictions, licensing requirements, and logistical bottlenecks have created a firewall. The silver in Shanghai is trapped, the silver in New York is scared, and the two prices have divorced. This is the most important signal you can look at right now. If silver was truly abundant, if supply was overwhelming demand, the price would be collapsing everywhere. It would be collapsing in China. It would be collapsing in India. It would be collapsing in the physical market. But it isn't. Only the paper market collapsed. Only the leveraged, derivative-driven market imploded. That tells you the crash was synthetic, and the physical world responded accordingly. While paper traders were panic-selling contracts, physical buyers stepped in aggressively. Industrial users do not care about RSI. They do not care about 5-minute candles. They care about securing supply. When price collapsed into their procurement range, they bought everything they could. Solar manufacturers, electronics producers, battery suppliers saw a brief window of opportunity and acted immediately. This is what professionals call an industrial put. It is not a promise. It is behavior. When price falls to a level where restocking makes sense, factories buy. That demand is inelastic. It does not disappear overnight. At the same time, something else happened that should terrify anyone betting on lower prices. Physical silver started leaving the vaults. Large withdrawals were reported. Metal was removed from the system. Not transferred, not rehypothecated, removed. That is not the behavior of a market drowning in supply. That is the behavior of a market preparing for shortage. So while the paper price was screaming collapse, the physical market was screaming, get me the metal now. This is where narratives break down. Turn on financial television, and what do you hear? Retail panic? Small investors fleeing? Bubbles bursting? They are blaming you. They want you to believe that thousands of retail investors all woke up at 2 a.m, collectively decided silver was a bad investment and smashed the sell button at the exact same second. That is not just wrong. It is insulting. The data tells the opposite story. ETF flows stabilized and began to turn positive after the crash. Bullion dealers reported surging demand. Traffic spiked. Orders flooded in. Retail did not panic. Retail bought the dip. The selling came from one place and one place only. Forced liquidation by over-leveraged institutional players and the algorithms that hedge their risk. So why is the media lying? Because they need a scapegoat. They cannot admit that a major leveraged position blew up. They cannot admit that clearinghouses were stressed. They cannot admit that emergency liquidity was required to keep the system functioning. That would cause real fear. That would cause a run. So instead, they blame retail. They gaslight you into doubting yourself so you will sell into their bids. This is not new. This is how markets have always transferred assets from the many to the few. Fear first, blame second, accumulation third. And that brings us to where we are now. The forced seller is gone, the whale is dead, the leverage has been flushed, The algorithms have stabilized, the physical buyers have stepped in, the floor has been defended. That does not mean price will move straight up tomorrow. Markets do not reward impatience, but it does mean the character of the market has changed. We have moved from liquidation to evaluation, from forced selling to deliberate positioning, from chaos to structure. In the next part, we are going to talk about what happens when ghost weekends, when liquidity returns, when institutional desks come back online, when the vacuum left by forced sellers is filled by real capital. We are going to map out the next phase, the risks that still exist, and the scenarios that could unfold from here. Because if you think the crash was violent, you're not prepared for what happens when the chase begins. Ladies and gentlemen, this is where everything comes together. Up to this point, we've exposed how the crash happened, who caused it, and why it stopped exactly where it did. Now we need to talk about what comes next, because markets do not stay in limbo forever. They move from one imbalance to the next. And right now, silver is sitting on one of the most explosive imbalances we've seen in years. After a forced liquidation event, the market enters a very specific psychological phase. Fear has already peaked, the weak hands are gone. The leverage has been flushed. What remains is hesitation. Traders are shell-shocked. They are afraid to re-enter. They are afraid to trust the bounce. And that hesitation is not a problem for the market. It is fuel. Markets do not rise when everyone is confident. They rise when confidence is scarce and positioning is light. Right now, silver is no longer in panic mode. It is in assessment mode. Participants are asking themselves whether what they just witnessed was the beginning of a collapse or the end of one. That question is not answered by opinions. It is answered by behavior. And the behavior so far tells us something very important. Price is holding structure. Volatility is compressing. Selling pressure is no longer aggressive. That tells you the liquidation phase is over. This is where the market transitions from destruction to reconstruction. The $75 level is now more than just a floor. It is a reference point. Every trader sees it. Every algorithm sees it. Bulls see it as the line that saved the trend. Bears see it as the level they failed to break. Institutions see it as the zone where liquidity proved sufficient. That shared awareness creates gravity. Price may move away from it, but it will continue to influence behavior. The longer price holds above it, the stronger it becomes. Now let's talk about timing, because timing matters more than most people realize. We are coming out of holiday ghost week. Liquidity has been artificially suppressed. Order books have been thin. Volatility has been exaggerated. This is not a normal market environment. But that is about to change. When the calendar flips and institutional desks return, liquidity floods back into the system. And when liquidity returns after forced liquidation, price often snaps violently in the opposite direction. This is what professionals call the vacuum effect. During the crash, sellers overwhelmed buyers because liquidity was absent. Once liquidity returns, the absence flips. There are no longer forced sellers. The leverage is gone. But there is still demand. That imbalance creates air pockets to the upside. Price does not grind higher slowly. It gaps, it jumps, it surprises. This is why the days immediately following a liquidity-driven crash are often more volatile than the crash itself. Not because fundamentals are changing, but because positioning is rebuilding in a hurry. Funds that missed the move are forced to chase. Funds that were underweight are forced to rebalance. Algorithms that went flat are forced to re-engage. The result is sudden, sharp movement. But let's be clear, this does not mean the path forward will be clean or comfortable. Post-liquidation environments are messy. There will be false starts. There will be sharp intraday reversals. There will be moments where it feels like the market is about to roll over again. That is how confidence is tested. That is how the market ensures that only committed capital remains. The key difference between a recovery and a relapse lies in how price behaves on pullbacks. In a renewed collapse, rallies are sold aggressively, volume expands on down moves, and support levels fail quickly. In a recovery, pullbacks are shallow, volume contracts on dips, and buyers step in sooner and sooner. So far, silver's behavior aligns more with the latter. That does not guarantee outcome, but it shifts probability. Now we have to talk about risk, because ignoring risk is how people get wiped out even when they are directionally correct. There are still landmines ahead, and pretending otherwise would be irresponsible. The first is currency risk. Silver is priced globally in US dollars. If the dollar spikes aggressively, it can temporarily pressure metals regardless of fundamentals. Sudden dollar strength, especially driven by policy expectations, can trigger algorithmic selling across commodities. The second risk is central bank communication. Markets are hypersensitive to tone. Even subtle shifts in language can trigger mechanical reactions. These reactions are often short-lived, but they can produce sharp tests of support. If such tests occur on low volume and recover quickly, they reinforce structure. If they occur with expanding volume and follow-through, reassessment is required. Context matters. The third risk is policy uncertainty, particularly around trade and export rules. Silver sits at the intersection of industrial necessity and strategic importance. Changes in regulations, licensing, or enforcement can alter short-term flows rapidly. These events often arrive without warning and are priced in violently. But again, volatility does not equal resolution. Many such shocks simply accelerate existing trends rather than reverse them. Understanding these risks does not mean fearing them. It means preparing for them. Markets reward those who expect turbulence and punish those who expect smooth sailing. The work now is not prediction, it is observation. Watching how price responds to stress, watching who shows up on dips, watching volume behavior. That information is far more valuable than any forecast. Zooming out, the broader structural backdrop remains intact. Silver exists in a world defined by high debt, constrained supply chains, and growing industrial demand tied to electrification, energy transition, and advanced manufacturing. These are not short-term narratives. They are multi-year realities. Short-term volatility does not erase them. In many cases, it reinforces them by discouraging marginal supply and shaking out weak participants. This is why experienced market participants focus less on dramatic days and more on what happens afterward. Anyone can react to a crash. Few can interpret the recovery phase. The real information is not in the panic. It is in the response to the panic. And so far, that response suggests resilience rather than fragility. What we are witnessing now is not euphoria. It is not complacency. It is cautious re-engagement. That is a healthy foundation. Markets built on fear tend to be stronger than markets built on optimism. When participants are hesitant, rallies tend to persist quietly. When everyone is confident, markets become fragile. Silver has survived its stress test. The market was pushed hard, liquidity was strained, confidence was shaken, and yet structure held. That does not mean the next move is guaranteed. But it does mean the trend has earned the right to continue, provided behavior remains constructive. The most important mistake traders make at this stage is confusing boredom with weakness. Sideways action is not failure, it is repair. It allows volatility to normalize. It allows positions to be rebuilt without leverage. It allows sentiment to reset. Those who exit during this phase often do so just before momentum returns. So the question is no longer, did silver crash? The question is, who accumulated while others panicked, and what happens when fear fades? That is where opportunity lives, not in the headlines, not in the drama, in the quiet aftermath. Nothing discussed here is financial advice. Markets involve risk, and no outcome is guaranteed. The purpose of this analysis is not to tell you what to buy or sell, but to help you understand what you are seeing. So your decisions are informed rather than emotional. If this breakdown helped you see the market differently, do not keep it to yourself. Like the video so more people can find it. Share it with someone who might still be panicking or confused. And most importantly, subscribe to the channel because we will continue to track the structure, the levels, and the behavior that actually matters as this story develops. Markets punish panic. They reward patience. And the real moves come after the fear fades. Stay calm. Watch the levels. And I'll see you in the next update.